Alphabet stock fell on Tuesday, even as the company announced the largest equity raise in its history. The share price dropped roughly 2.6% in pre-market trading on news that Google's parent would issue $80 billion in new stock, its first major equity offering in more than 20 years. That drop is the question. Alphabet is not a distressed company seeking a lifeline. It is a company generating hundreds of billions in revenue, with operating margins that most businesses would not dare dream about, deploying capital into the infrastructure of what every major bank is calling the decisive technology investment of this decade. And yet the market's first move was to sell. The session itself had been broadly constructive. U.S. indices were firmer, with the Dow gaining ground even as the Alphabet news filtered through. The broader AI rally that has driven equity markets through 2026 continued on most fronts. Chip makers, cloud platforms, data center operators all showed resilience. SpaceX filed for a NASDAQ listing, targeting a valuation between $1.75 trillion and $2 trillion, adding to a sense that the AI capital formation cycle is entering a new phase. Anthropic confirmed it had submitted confidential IPO paperwork to the SEC at a post-money valuation of $965 billion, following a $65 billion Series H round that closed only days earlier. Berkshire Hathaway, under new chief executive Abel, committed $10 billion to Alphabet's equity raise in a direct private placement, the conglomerate's second major AI bet in 2 days, after a separate $6.8 billion acquisition of homebuilder Taylor Morrison. Berkshire's existing Alphabet holdings stood at $16.6 billion as of March. Abel is spending at a pace that Buffett never did. The capital is moving, and it is moving toward AI infrastructure with urgency. So the session backdrop was not hostile. What it was expensive, and Tuesday made that cost explicit. The $80 billion raise breaks down into 3 parts. A $30 billion underwritten public offering, split between $15 billion in mandatory convertible preferred stock and $15 billion in common stock. A $40 billion at-the-market program running from the third quarter of 2026, and the $10 billion strategic placement to Berkshire Hathaway. In total, this is new supply entering the market at scale. The filing also disclosed that Alphabet's projected capital expenditure for 2026 sits between $180 and $190 billion, with 2027 capex expected to increase significantly beyond that. Half the proceeds are earmarked for AI infrastructure and global compute. The other half covers tax obligations on employee equity vesting, meaning a meaningful portion of the raise does not go into the business at all, but out to employees whose stock has appreciated. That is the mechanism the sell reaction is pricing. Alphabet only months ago authorized a $70 billion share buyback program, a program that signals to investors that the company believes its stock is undervalued. Now it is issuing new stock, which signals the opposite. The two signals exist within the same fiscal year. Holders who bought in on the buyback logic must now re-weight that conviction against a capex trajectory that, by Alphabet's own disclosure, will only expand through 2027. The position pressure is not abstract. The question is whether the buyback-era thesis that Alphabet was returning excess capital because the compounding value resided in the existing business is still intact, or whether it has been replaced by an infrastructure bet whose payoff horizon is measured in years, not quarters. The contradiction runs deeper when Berkshire's move is placed beside the market's. Abel committed $10 billion into the same equity at the same moment the stock was falling. He is the buyer. The market is the seller. One of them is treating the $80 billion raise as a signal that AI infrastructure will compound through the decade. The other is treating it as dilution. Both cannot be right about the same asset at the same time, and which frame holds will determine whether Alphabet's capex to revenue conversion over the next 18 months justifies what is now the largest non-distressed equity issuance in the company's public history. What is not yet visible is who among institutional holders has already repositioned and who has not. The at-the-market program does not launch until the third quarter, which means the full volume of new supply has not entered. The pressure on existing holders builds gradually, but it builds.
Alphabet is not alone in this moment. The unresolved question from the sell reaction connects directly to what the broader AI capital cycle is now asking of public market investors. At what point does infrastructure spending become self-funding, and how long must holders carry the dilution cost before that inflection arrives? Anthropic's IPO filing frames that question in sharper relief. The company reported an annualized run rate revenue of $47 billion and is widely described as approaching its first quarterly operating profit. By Deutsche Bank's estimate, Alphabet generates more than $350 billion in annual revenue. The scale is incomparable. But Anthropic's path to profitability is reportedly on a shorter horizon than OpenAI's, and its valuation at $965 billion rests on a market that has not yet been asked to publicly price a frontier AI model company. When Anthropic lists, it will become the first real benchmark for how public investors value the AI model layer. That benchmark will recast how Alphabet's own AI infrastructure spending is measured, not as an input cost, but as a positioning bet against a rival whose unit economics are now on record. The historical parallel is imperfect but visible. In 2000, the largest equity raises of the cycle came at the moment when capital requirements outpaced the market's willingness to fund them. The comparison is not about the quality of the companies. Alphabet's existing revenue base is categorically different from the dot-com era. It is about the sequencing. The moment when the sector's most capitalized incumbent pivots from buyback logic to issuance logic is historically the moment when the narrative shifts from compounding to scaling, and scaling narratives are repriced on execution, not expectation. The verification benchmark is Alphabet's CapEx conversion. If the $180 to $190 billion CapEx range for 2026 produces measurable AI revenue acceleration in the second half of 2026 earnings, particularly in Google Cloud's AI-driven growth rate, the dilution cost the market priced on Tuesday begins to look like entry. If CapEx continues to expand into 2027 without a revenue inflection that matches the $80 billion raise, the buyback era holders who stayed through the issuance will face the harder question, whether Abel's conviction is confirmed only by results that arrive too slowly for a quarterly reporting public company to hold. The more durable version of that question is not whether Alphabet spends correctly, but whether public market capital, which prices on quarters, can remain the primary funding mechanism for a build-out whose returns are priced on years. Tuesday's sell reaction may be less about Alphabet specifically and more about who pays first when the gap between those two timelines becomes explicit. Every day after the close, we publish a market route and key issue analysis. Subscribe to the channel.